Hello, and a very warm welcome to my whiteboard session on security analysis and portfolio management. A very interesting topic, so let's get started. An investment is an asset or item acquired with the goal of generating income or appreciation. The term investment can refer to any mechanism used for generating future income. In the financial sense, this includes purchase of bonds, stocks, real estate property, gold, etc. Additionally, a constructed building or a facility used to produce goods can also be seen as an investment. The production of goods required to produce other goods may also be seen as investing. Let's take a look at the different aspects on investment: views, the types, the objectives, and the characteristics or features. Let's begin with views. Generally, economic and financial are the two viewpoints of investment. However, there are economic and financial experts who would look at a third term, layman. To begin with, economic investments are undertaken with an expectation of increasing the current economy's capital stock, and that consists of goods and services. Capital stock is used in the production of other goods and services as desired by the society. Investment, in the sense, implies the expectation of formation of new and productive capital in the form of, say, new constructions, plant and machinery, inventories, and so on. These kind of investments generate physical assets and also promotes a lot of industrial infrastructural activity. From a layman's viewpoint, this has more to do with keeping money aside to meet certain milestones in life. For example, marriage of a son or daughter, to own a house, buy a car, etc. Financial investment viewpoint, the third one, is all about putting money into something with the expectation to gain. And when you think about making a gain, you do a lot of analysis in your at the back of your mind. You talk to people around you, you do a lot of research, and then look at the time period, the risk, the return aspects, etc. Therefore, putting money into something with an expectation of gain with thorough analysis would form a part of financial investment strategies. And if you don't do that, that would mean you are entering into speculation or gambling. Let's look at the types of investments or the investment classes. Corporate securities that would comprise of, say, stocks, bonds, debentures, derivatives, futures, options, etc. Bank deposits, it could mean your savings accounts or your fixed deposits, and this could also be done with non-banking financial institutions. Investment in post office deposits like National Savings Certificate, Kisan Vikas Patra. When we move on to investment in insurance, that is meant to minimize unforeseen risks. You have options of investing in life as well as non-life insurance policies. Investment in property and in real estate would definitely mean appreciation in future. And property or real estate are two asset classes that from time immemorial seen as a guaranteed asset where you would definitely be able to gain appreciation over a period of time. Government securities like government bonds, treasury bills, and investments in, say, public provident funds are considered risk free because in addition to a guaranteed principal, returns too are assured. Investment in gold and investment in mutual funds are the ones to conclude with. Investment in gold has also remained as a traditional investment strategy where you look at investing in gold as an option for you to liquidate gold into cash whenever it is required. And in mutual funds, today you have sectoral funds, you have exchange traded funds, you have gilt securities. All these options are available where you can choose what would suit your risk appetite, your income, and your age. Moving on to objectives. The objectives would denote the financial goal of an investor. An investor may wish to maximize current income, maximize capital gains, or set a middle course of current income with some appreciation of capital. And therefore, defining investment objectives helps to determine the investments as an individual would go by. It could be your primary objective or your secondary objective. The primary objectives are capital appreciation, current income, capital preservation, and speculation. And the secondary objectives are to minimize tax and ensure that there's a lot of liquidity in your portfolio. Capital appreciation, definitely. If you're investing in something, you're looking at making gains over and above the principal that you've locked into your asset. Current income, more pertinent from those who are entering into the age of retirement. So because they've exhausted their options of gaining regular income, they should look at parking their money in such a manner that they get regular income and enjoy their retirement or their post-retirement phase in a very graceful manner. Speculation, more to do with the stock markets, where you enter into making guessworks based on the movement of stocks or market sentiments and then decide to invest in certain scripts. We move on to characteristics or features of investment. One is simple to understand, simple to invest, and you have a lot of tax benefits on some instruments. For when you look at tax benefits in the Indian context, you will have section 80cc, 80db. All these sections are there for you to use them as guidelines and decide where to utilize them and when, because the tax benefits on some instruments are more when compared to others. So investors should plan to minimize their tax liability. Liquidity refers to the option that you have where you can convert an investment in an asset into cash. In other words, it is available immediately in cash form. So when the liquidity is high, then the return may be low. Marketability can be used alongside liquidity, and this is another feature of investment that would indicate the marketable nature of the asset class. It means buying and selling or transferability of securities in the market. Risk is another feature, and it refers to the loss of principal amount of an investment. No one would want to have their principal amount lost, let alone the gains that will come as an appreciating factor later. Risk also depends on other factors. The investment maturity period is longer. In this case, the investor will take larger risk. Government or semi-government bodies are issuing securities which have less risk. And in the case of debt instrument or fixed deposit, the risk of above investment is less due to their secured and fixed interest payable on them. The safety aspect is next, which is a crucial element of investment. Investor prefers safety about his capital. If investors prefer less risk securities, he chooses government bonds. In the case, the investor prefers high rate of return and would choose private securities, and safety of these securities is very low. The next feature is hedging one's risk against inflation. When price of essential commodities go up high in the market, the going gets difficult. Even it makes it difficult for you to meet your basic physiological need. Factoring in the need to safeguard your investment and additionally looking at future inflation is very important. The concealability factor is next. Sometimes we all resort to hiding from our relatives and the taxman about investments in gold and also in non disclosing assets from a taxman perspective, hiding them away from our taxman, acquiring, say, for example, property through escrow accounts. Therefore, the element of concealability. Term as a characteristics in investment would mean the period of investment and the time of appreciation, be it in the short term or long term or for the phase of retirement. And let's look at the last term, return. All investments are characterized by the expectation of a return which delineates the purpose. In fact, investments are made with the primary objective of deriving a return. The return may be received in the form of yield plus capital appreciation.